CSV slides, and then I'm gonna also share my slides. A couple of things I think you should focus on as we go through here. Okay, everybody see my screen? All right.
Yeah.
Okay.
Yes.
So let's talk about this. Some disclaimer: the information in this presentation is not interpreted, should not be interpreted as accounting, investment, legal, or tax advice. It's not solicited, definitely not solicited to buy anything. This is only a class to teach you about the material. This workshop is for educational purpose. We do not guarantee you will pass because of this presentation, but I also will guarantee that you will not pass if you do not take the test. Okay, so you got to take the test. Okay, this does not replace any pre-licensing requirements. You have to have your pre-licensing requirements, which means you got to get your testing materials. You got to go through your practice exam. This only a supplement to assist you with your studying. Okay, to help you understand. So preserve the integrity, please. No no photo, no video, and record this session. You guys are going for your security license. You know about security. You know about the compliance. That we got to follow all these compliance rules about video recording and everything. Okay, so you got to take notes. Take as much notes as you can, and then go from there. But I do ask you, if you're gonna take a picture, make sure, Miss Dolores, that I'm smiling when you do take my picture. Okay, so don't take my picture with an ugly face and everything. Make sure I'm smiling so that you get a good picture of me. Okay. All right. So um, this is the every day we know the reason why you guys are taking a test because we want a holistic approach to financial literacy, right? We want to be able to help the families out there, and we want to help them with everything. That's why, to me, it's a privilege to be fully licensed. This is something that you can make a definitely a professional career out of it, where you can separate yourself from everybody else. Everybody else, the majority of the companies out there only do life and health, while we do life and health and investment at the same time. Okay. And this is going to separate you. This is going to be somebody in your community. They're going to look up to you because they know that you're an investment advisor or a financial advisor rep. Okay. All right. So on this test, this is a introductory FINRA exam for security industry. What does the exam cover? All right. There's four main categories. Your knowledge of capital markets. All right. So we're going to go over capital markets, products, and the risks. So we're going to go over some products, but to me, the best way to know about the products is to get to the what? The Tuesday afternoon training when we have the security training. Those are the best way to know about the products and also field training. We're talking about prohibited practice, things that you cannot do. Okay. If you have, I know everybody on here should already have your life and health. So you know you can't do certain things on life and health, and definitely there's certain things you can't do with your security license. And we're gonna talk about regulatory framework, the regulatory and how it works and everything. So you're gonna have 75 questions on your test. You need a 70 to score to pass. Now, when you pass, they're not gonna tell you what your score is. They're just gonna say pass. If you fail, then they'll tell you how much you felt like. We have a lot of people actually made about a 68, 69. Uh, Sometimes I will tell you, sometimes they will, doesn't mean that you actually make a 70 on the exam and you pass because depends on the difficulty of your test. There's some tests that's more difficult than other tests, and they will curve it a little bit up. All right. Just know that you pass or not pass. That's all. Okay. You have an hour and 45 minutes, and it's valid for 4 years. Of course, when you pass the SIE, you're not going to wait 4 years to take your 6 and 63 and be fully licensed, right? But it's just valid for them. No firm sponsorship, which means you can take SIE on your own. Does not allow so, but doesn't mean just because you have your SIE doesn't mean that you actually are licensed, all right, are ready to take your start to selling products. Right now, I want to stop sharing here. I want to share something else real quick, and I want to share this right here. This is the breakdown, guys, of the test. Okay, This is very important. Remember, we talk about capital markets that make 16% of your test. Okay. Understanding the products and their risks makes up 44%. So knowing the products and the risks of the products, like the RILA, like mutual funds, like variable annuity, VULs, products like that. Okay. Understanding trading customer accounts and prohibited activities, 31%. Overall regulatory framework, 9%. So which two categories do you think you should focus on?
2 and 3.
2 and 3. All right. So this is an interactive, guys. You can unmute yourself. Just make sure that you mute yourself when you're not talking. So I would focus on 2 and 3. If I'm doing practice exam, I would say, hey, give me practice exam on 2 and 3. How do you do that? All right. I know. Let's say, for example, you do your STC. Uh, you get your materials through STC. They might not give you part 2 and 3, right? So, Chris, this is what I do. I will go to ask my best friend. All right, my best friend is Chad. All right, and I would say, Chad, can you give me 100 questions on the SIE to talk about understanding products and their risks and understanding trading, customer accounts, and prohibited activities? And I would do those questions over and over and over and over. Okay. We live in a society now where we have so many tools to outside. So if STC or whatever company that product provider you're using that give you the exam, use that. If not, go to your best friend, chat, and tell them to give you those questions. All right. If you have 15 minutes at work or something, tell chat, hey, give me 15 questions about understanding products and the risks. Right. And study that way. Or you go on YouTube, um, the guru, talk about that, and they're gonna be able to do that. Okay. So know how to focus, guys. Know how to pass the exam and know which areas to focus on. To me, I wouldn't focus too much on area number 4. That's only 7 questions, right? You can probably. All right, we're good with that. Okay. All right, Miss Stephanie, I'm also gonna make you co-host for me, and this is the reason why. Uh, Somehow,
Sure.
every time I'm teaching or I'm doing training, it's storming outside. So it's storming outside now, just in case, guys, my internet or my power go off. I'm gonna make them co-host Stephanie and Long, just in case, so that we wouldn't completely get kicked off. Okay.
Sure
All
thing.
right. Okay. So let's talk about the Federal Reserve basics here. The Fed's primary goal is to influence interest rate economic activity using the following tools, right? So the Feds, they basically do this. They can influence the economy by buying or selling security, open market operation, right? So they can do that. How do they influence that? The reason why we need to understand this, we need to understand the market, we need to understand the economy, and then we need to understand about interest rate. Now, when the government buys back security from the open market, which means they buy security products, they buy stocks, they buy security bonds back to mutual funds, back to them. They start to hold it. What happens to the economy if the Federal Reserve buy securities? Somebody tell me.
Goes down.
Right? No. What happened to the
Economy
economy?
will contract.
Right. So think about this. If they're buying, then which means they're taking money out of the market, out of the economy, right? So which thing you think it is? Because if the economy, the inflation is up, right? Which means there's a lot of money out there. The inflation is up. So they want to take money out of the market so there's less money into the market, right? So they want to buy or they want to sell. So when they want to sell, which means they put money into the market. Okay. So you can either buy or sell. So it affects it that way. Okay. What about discount rate? Bank borrow discount rate. How's that affect the economy? So listen, for the banks borrow money from the feds. Okay, if the discount rate, the feds to the bank goes up, if the interest rate that the feds charge the bank to borrow money from them goes up, what happens to the bank?
The bank will lend less money. There's less money out in the market.
Right. So, right. Fernando, you're right. So the bank, because the interest rate is higher, they borrow less from the government, right? So because they borrow less from the government, who do they need to borrow from? Who are they going to borrow from, guys?
Each other.
bank.
They're going to borrow from each other or they're going to borrow from you. How do they borrow from you?
Selling stocks.
No.
They
They're
use
gonna
money in
borrow
your
from
savings
you.
accounts.
Municipal
On,
bonds. Bonds.
right. So on your bonds, your CDs, they're going to give you higher
Right.
interest rates. So then gives you more incentive to give them more money. Okay. So now they're borrowing money from you and start borrowing money from the feds. Right. Now, if they borrow more money from you, guess what? Guess what you think? What do you think the credit cards and loans and car and mortgage interest rate do?
It will
They
go
will
up.
raise the rates.
It go up. Okay. So you understand how that all works. Okay. Now, what about the reserve? So a bank has to have a certain amount of reserve sitting in the bank that they got to have with all the people's money depositing. They got to hold a certain amount, Fernando, in the bank. Now, if the government comes in and says, you know what, we're going to raise the reserve amount, you got to hold more money. So if they hold more money, what happened? What does the bank do?
They can't
They
be
will lend out less.
Less money in
They
circulation.
release more money.
So they will lend money less.
Yeah. Yeah.
So if they lend money less, what happens to the interest rate?
Goes
Increase.
up.
Goes up. Goes up.
It goes up. Okay. So do you understand how every one of those things affect the economy? So the feds are sitting there and they go, okay, you know what? Do we buy or sell stocks into the market? Do we lower or raise the discount rate? Do we raise or lower the bank reserve? And all of that will affect everything else. Will affect everything else. Okay, so when you understand that, you understand about interest rate and how it affects the market. Okay, now interest rate and inflation. This is very important. This is something you got to memorize, or this is something you get write down. It's a seesaw. When interest rate goes up, bond price goes down. Okay, you do the seesaw. Interest rate goes up, bond price goes down. All right. Interest rate goes down, bond price goes up.
Oh,
So interest and bond price is opposite. So is inflation and purchasing power. We know that. From the blue book, we know that that's the case, right? All right. So interest rates is one of the biggest drivers of the market, right? And we know what affects interest rate, right? We just talked about three things that can affect the interest rate. And the real value of money is inflation. The real value of money is inflation. Okay. All right. Everybody understand that?
Yes.
All right. Great. Great. So let's talk about the business cycle. I mean, Jovita just talked about this business cycle. In the business cycle of the economy, you have expansion, which is growth and rising stocks. And then peak. When you get to the peak, it's overheating, risks increase, which means it's gonna what? It's already peak. It's probably gonna fall. Contraction. The whole economy slows down. Falling markets. Third, with the bottom, recovery begins. Now, okay, so let's talk about some of this. If the market was expanding, growth and rising stock expanding, right? Is that good? If you were the Feds, what do you think? Is that good or what?
yeah, it is.
Yes.
It's good for the
It
economy.
is.
Good.
Okay,
It depends. It depends.
okay, who said that depends?
Chris, I did.
Okay, so Chris, explain yourself.
Well, if the government, if the Fed's option or the Fed's role is to determine the flow of money, if it increases too fast, then there's a problem. So it depends
Right.
on what's going on in the market in the world.
Right, so when it
Essentially.
gets into the peak, right? So when their growth expansion is good, but when they gets into the peak was when it's bad, right?
Mhm.
It's overheating. You know, so with overheating, you got to slow it down a little bit,
That's why you
right?
have leading indicators and lagging indicators of what's going on in the market, and that determines
Right,
what the Fed does with money.
right. Absolutely, Chris, and that's the reason why we take this test so we can be licensed so that we kind of know what's going on, right? And we know what's going on in the market. Now, of course, we can't predict the market. Nobody can predict the market, but at least you understand the market a little bit more. Okay. Stock performs best during expansion and weakest during contraction. Because if the market's falling, of course, it's not performing that well, right? But guess what? Because we are a holistic approach, we can help people. Doesn't matter what cycle it is. We can be able to help them, right? All right. So capital market and participation. Capital markets connects issuers that need capital with the investor that needs return. All right. So investor, they need returns, right? So they need to raise capital. All right. So these are uh, these I'm sorry the issuers. They need money. They need to raise capital. And so they turn to broker dealers. Broker dealers are the middle guy, facilitate between the buyers and the seller. Okay. And the investors provide the money. Right. So sometimes a broker dealer can be what? Can be an individual. It also can be a institution, but it also can be what? It also could be the government too, right? The government can be the investor or broker dealer, right? So this is how securities go this way, money goes that way. Okay. So that's what we call the capital market right there. And to understand the capital market. So when understand the market, there's a primary and secondary market. Right? There's a primary and secondary market.
Can you
So the
put that,
primary market,
can you put that screen back up, please? The one
so you can
before
take a
this.
picture.
Yes.
No, what's the first
No.
slide that I said? No taking pictures, right?
I
Have you
wasn't
taken,
on. I
right?
just want to see. I'm writing too.
Okay. This is very simple to write, right? Okay. I know when people say go back, they're probably taking pictures.
He told you already when you take picture, he need to be smile, no athlete. Okay.
Yeah, so make sure I'm smiling, okay? All right. It's primary and secondary market. So primary market, guys, issuer receives proceeds. New securities issue. For example, an IPO, an initial public offering. This is a primary market. Primary market is hey, I got some new security, new stocks that are going out. I'm raising money. This is the new securities, right? So that's the primary market. Secondary market is investors trade between themselves. So once it comes from the primary and it's being sold, it's going to be resold again into the secondary market. Okay. So the secondary market, it's already been issued. Example are the New York Stock Exchange and the NASDAQ. Okay. For example, if you go buy a new car, is that primary market or secondary market?
Primary.
Very.
Primary market. So you're buying it something that's new. You go buy a used car, you're buying on the secondary market. So the primary market is depending on what everybody's willing to pay for it, right? Secondary market is what people are willing to trade for it. Okay. So exchange versus OTC market. All right. So now you're going into the secondary market. Um, it could be exchange center like the New York Stock Exchange and Nasdaq. It's centralized. It's in one place. They list all their securities out, and it's more regulations. Has a lot more regulations. Okay. Now you got the over-the-counter market. Over-the-counter is a dealer-only network. It's dealer working with dealers, not centralized, less regulation, more risk.
Yes.
Okay, a lot more risk. Okay, because over-the-counter, you sometimes you don't know what you're buying. All right. So now, for example, if you buy a used car and you go to a dealership to buy a used car, is it an exchange or over-the-counter?
Over the counter.
Exchange.
It's an exchange because it's centralized. It's got a lot of regulations, right? But if you go onto Facebook to buy a car, what do you think it is?
OTC.
Over
Over the
counter.
counter.
Over counter.
Right.
More
It's
risky.
a dealer with dealers, more risky, right? You don't know what you're buying. Less regulation, more risk. It's not centralized. Okay. So
Okay.
now do you understand that when you're buying, be able to buy primary market, secondary market, exchanges versus over the counter. All right. So sometimes you're going to hear this. It's going to be what's a primary market? What's a secondary market? What's over the counter and all of that. All right. Any questions, anybody? We're good?
We're good.
All right. All right.
Clear.
All right. So remember, these slides we're meant to where we're not meant to where we're not meant here to teach you everything. But the way I do at these slides, if you understand these concepts, then you understand how to take the test. Okay. All right. Let's talk about monetary versus fiscal policies. Okay. Again, this is to understand the markets and everything. Monetary policies, Federal Reserve, they control the interest rate, right? What we talked about, and they manage the money supply. Okay, how do they manage the money supply, guys?
Printing money or
No,
restricting, no?
if you want to print money, yes, you kind of. But no, we talk about printing money. The government talks about the tax and spending. Yes, printing money, okay, is one part of it. All right. But morally, what we just talked about, Fernando, we talked about how they,
Comment about.
Issue,
how they control, right?
making
How they
money
control the
available
bank,
or
right?
restricting money. Okay.
Right. So you gotta remember that. Yes, printing money is one of it, but remember they can control the money supplies by the bank reserve, the bank interest rates, right? Okay, buying or selling securities back into the market or buying it. Okay. And the government, they just do the taxing and the spending. Okay.
So one thing to think about here is the Federal Reserve is not the government. That's an outside agency. The Federal Reserve does not control the printing of money. That's the government.
Right. They're the monetary policies. Okay. They don't control. The government can print some more if they need to print some. Okay. A lot of times they print it, guys, just FYI, it's nothing to do with test because they take back all the old money anyway and take that out of circulation. All right. Equity overview. Stocks. Company issue stock to raise capital, right? Company issue stocks because they need money. They need money to run their business, right? So they raise, in exchange, they're going to raise it. They sell these to shareholders. They sell the stocks to shareholders. Shareholders are partial owners and they might or might not have voting rights. And we're going to go through those who has voting rights, like the common stocks. And the shareholders, they get dividends and price appreciation. Profit and loss, residual claims on earnings and assets. Okay. So companies sell stocks, shareholders buy those stocks, you have partial ownership, and you partake in the dividends and the price appreciation. Okay. Shareholders are last in liquidation, but offer the highest growth potential. Okay. And we're going to talk about that a little bit more in the next slide. All right. So let's talk about common versus preferred stock. Common stocks and preferred stocks. Okay. Common stocks control, basically you have control and you have growth. Preferred stock, it's income and safety. Common stocks, when you buy common stocks, you have voting rights. You have voting rights for that company. If there's 1 million shares of that stock out there and you have 1 share, then you have 1 share vote versus 1 million other people that's going to vote. Okay. But your dividends is not guaranteed. Dividends are not guaranteed. So dividends are when the companies start making money, they issue dividends out to individual stocks right there. Maybe at 25 cents, maybe $1 per stock. It all depends. And it has the highest growth potential. Appreciation of your stock versus the preferred stocks. Preferred stocks, you have no voting right. You're not voting on anything, but you have a fixed dividend. You know exactly, you have dividends that's coming in, fixed amount. Okay. You're prioritizing liquidation. And we're going to talk about liquidation in a second. So preferred stocks behaves just like a bond, where you get dividends coming in. Common stocks represent ownership. Okay. Now, which one would rather have? Would you rather have common or preferred?
Common.
It depends.
Caroline? All right.
Depends.
Caroline, you said
Common.
common. Tell me why.
Depends.
Caroline, you told me common. What do you prefer? Tell me why.
Well, because I have potential growth, and I have a voting right on what's going on with my money.
Okay. Now, I want you, Caroline, to always remember this, okay? When you are security license, it's always going to be depends on the situation.
Okay.
Okay? Depends. If I have a lot of money and I have $1 million and I get fixed dividend every single year from my $1 million worth of stock, and I really don't care about the growth of anything, I really don't care about a voting right,
Prefer.
which one would I rather have?
Prefer.
I go for
Either.
prefer.
I would have the fixed dividend, right? What if I want that fixed dividend? What if I want a 3%, 4%, 5% dividend every single year?
Preferred.
Yes. But what if I want I don't care about the dividends. I just want my stocks to appreciate.
Common.
Common stock.
And I do common. All right. And if I want ownership and I care about the company and I want that voting right. But I also then so shareholders right. You have voting rights, right? You elect a board. You get dividends, but it's not guaranteed. Okay. Residual claim on asset. You're a last one. If that company goes down, they file for bankruptcy, they liquidate, you're going to be the last one.
To get your money.
Get your money. Right to information. So you get the right to information, what's going on with the company. Common shareholders have these rights. Preferred typically do not have these rights.
Mm-hmm.
Okay. So let's look at this liquidation priority. So on the company assets, the companies, if they liquidate, who gets it first? Secure creditors. Secure creditors get it first. Unsecured creditors
Get it
get it next.
last.
Get it next. Unsecured creditors get it next. Okay. Preferred shareholders are the next one.
The last couple.
Mm.
The last one is the common shareholders. The majority of shareholders out there, guys, are the
Common.
common shareholders. The majority of your stocks and equity that you buy are common shareholders. There's a less percentage in preferred shareholders.
Hmm.
Okay.
Frank, I
So
have a
that-
question.
Yes.
When this happens for common shareholders, do they get a letter, something from the company for their taxes or something like that to remove those?
Well, all they're going to get is their stock price going down,
Okay,
right?
okay.
Hey, Frank.
So
Yeah.
that means common shareholder is better than the
No,
than the rest.
Secured
Andreas, I want you to
creditors.
learn. I want you
It
to
depends
learn.
on your situation. Depends on your client's
Secured
situation.
creditors are better. Or even unsecured creditors.
That
It
just depends on the
depends.
situation, guys. All right,
Depends
depends on the
on.
situation. Remember,
It depends
but
on
the
your
majority of the
situation.
time, you are not going to be a secured creditor or unsecured creditors. Okay. All right. Chris, you had a question?
I was gonna say that as a common shareholder, since we have access, you'd have access to information. You'd be able to see what's going on with the company on a quarterly basis by the stuff they send out. So we'd be the first. You'd be the first ones to know how the company's doing, and if you wanted to sell that stock, you could at the higher price.
Yes, you could. You have information. It's not insider information, it's public information.
As a preferred shareholder, you don't have that, right?
You don't get the information.
So we have the first option to be able to see how the company is going before anybody else does, to determine what our course of action will be if a company is on the downhill side of things before it starts to
Yes.
get to a point where it's to be liquidated. So it all depends on where you want to be.
All right. It's just remember, guys, most of the times you're buying, you have mutual funds, so you actually don't even know what stocks you have, equity you have, right? But it's just that in this kind of question, it's just when you answer these tests, it's just you're last in line. You're last in line on all this, on liquidation. Okay. All right. Let's talk about rights versus warrants. Okay. Rights versus warrants. Okay. Rights are short term, issued to existing shareholders, discounted purchase price. So if you have a rights, you know that if they give you a rights, right? They're going to give you rights that are very short term. They give it to existing shareholders, and they give you a discounted purchase price. Okay. On the other side, you have warrants. Sometimes they give you warrants. It's long term. You get a fixed exercise price, often issued like with bonds. So usually warrants are bonds, where it's for long term. Get a fixed when you exercise price, which means when you sell it, this is what you're going to get. Okay. So those are rights and warrants. Rights usually raise capitals. Warrants are often used as incentive.
What? Warrants are what?
Warrants are often used as incentive.
Incentives.
Right? It's incentive for you to give them money for the long term, and they're going to say, if you give me 100, I'm going to give you so much back in the long term, and that's how bonds work. Okay, very easy to understand. All right, so let's talk about debt securities. Debt securities Company issue bonds to raise capital. So when we talk about debt security, we're mainly talking about bonds. Okay. So company issue bonds to raise capital. You got investor, lend money, bondholders or creditors, right? So they're the one that's going to lend money to the company and payments, interest, and then later you get payments, interest plus the return of principal. So bond company, let's say they issue a bond and you're going to lend it to them. You might be the bondholder or you might be creditors. Okay. And they're going to say, you know what? We're gonna get it to you, $100, returning your principal plus an interest rate on top of that. It's called a coupon. All right. So one of the things you need to know is return of the principal. That's the par rate, the par value. That's your return of principal, and coupon is referred to as interest. Okay. Interest, coupon, same word. Par is return of principal. Bondholders, creditors. Right? It's just like in this phase right here. If you go to a bank and you ask for a loan, which one are you?
Trader.
You're the company,
borrower.
right? You're the company. You're asking for a loan. You go to the investor. You ask for a loan, and guess what? You have to pay them back what you owe plus coupon,
The interest.
right? So it's the same thing. It's the same thing that companies do out there. Debt holders are paid before shareholders. Debt equals loan, not ownership. So remember, debt, secure, debt owners, unsecure, and then prefer, and then common. Right? So debt holders are paid before shareholders. So these debt holders, these bonds and stuff, you don't have voting rights. You don't have ownerships. All right, so let's talk more about these bonds. Okay, the first thing we need to know is the current yield, income today. What's the interest rate? What's the price? Okay, current yield. So you see on a test, they're going to ask you about current yield. You know it's the income today. What's the price today and the interest rate today? Yield to maturity. Interest plus gain or loss. That's your total return. Yield to maturity. How much interest, Caroline, you have plus your gain or loss on that bond. Coupon rate. Coupon is what?
Interest.
Interest. So sometimes they say the nominal yield, which is the stated interest. They love to, in fact, that give you a whole bunch of different names, all mean the same thing, right? Coupon, interest, nominal yield. And then yield is also what, guys?
Right.
Interest plus.
Interest. It's also interest too. Okay. So the current yield, coupon price. Okay. So yield to maturity is the most complete measure of return. So remember it said the interest rates and bonds. Okay. So when you look at this, the current yield income today, coupon price today. Okay. That's going to be affected by the current price, the current interest rate. So what's the seesaw? Remember the seesaw?
Mhm.
What's the seesaw? Interest rate goes up,
Go
bond
up,
price goes
goes down.
Gain or
Okay.
loss?
down. All right. So creditors rating on these bonds, all right? We're talking about bonds and these creditor ratings. We have what we call investment grade. They're low risk, higher credit quality, lower yield. Ratings are usually BBB, BAA, or higher. So just remember BBB are higher. Investment grade, which means they're good, but anything that's low yield, low risk becomes low yield. Low risk, low yield. Okay? Junk. Junk. High yield. Okay? I know you guys, some of you guys are taking pictures, but don't make it too obvious to me that you're taking pictures, okay? And also make sure I'm smiling.
Then stay smiling.
Yes. All right, so junk, high yield, higher risk, higher yield. Higher risk, higher yield, lower credit quality, right? Because hey, if if my credit is not good, let's say I'm a company that's going to issue you a bond. And Caroline, you're going to come to me and say, Frank, your credit's not so great. And that's going to mean, which means I'm going to take a higher risk. For me to take a higher risk, what do you have to give me? You have to give me a higher
Higher rate.
Interest.
yield. Higher yield, which means higher interest, higher coupon, whatever, right? So you see that? Now, if
Mhm.
I am an investment grade, if I'm a company that has higher credit quality, my credit history is good, which means I'm going to have low risk for you. If
Mhm.
I'm going to have low risk for you, I'm going to have a lower return for you because low risk,
Good.
low return, low yield. Okay. So I want you guys to think about why these are what we call junk bonds and investment grade bonds. So you're going to hear the word junk bond a lot. Junk bonds, which means junk, right? So like for instance, you go to a garage sale. Hey, it's going to be, you don't know what's the quality of what you're buying, higher risk, right? So you better get what? You
Higher
better get
yield.
a higher return, which means you go to a garage sale, it better be a better price for you. Versus going to a secondhand store that you know that their quality, they've been selling it for a while. They got good credit quality, so lower risk, which means
Lower
Higher
lower yield.
yield.
Okay, so that's what this is at.
That's
Higher
a good.
risk equals higher yield. That's all you remember. Higher risk, higher yield.
It's a trade-off.
Higher risk, higher yield. That's with everything in life.
Can I ask a question?
Yes.
Does this have anything to do with high yield savings account?
High yield saving account? No, this is more of credit ratings like with bonds and stuff. That's credit
Okay.
saving. Okay. Saving accounts, remember, Agnes, what did we told you it's going to be affected by at the beginning?
Interest,
Interest. So who controls interest?
bank,
Fed.
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 Markets.
The feds, right? Remember we said that the feds, they control that by buying and selling security, raising the bank interest rate,
And the money
or
supply.
the reserve right, how much your reserve amount is. Okay. All right. So you guys are you're all expert. Everybody's going to pass the test tomorrow.
Amen.
Yes. Bonds risk. All right. So I know this is a interest rate risk. Price is opposite to interest rate. Okay. That picture shouldn't be there, but price opposite to interest rate. The longer it takes to mature, which means the longer it takes to mature, which means the
More
contract ends, the more risk you have. Interest risk is the biggest risk for bond price. Why? Why is interest risk the biggest risk for bond price?
Because
Could you
it takes
repeat?
longer.
Because you never know what the Fed's going to do. It could lower or raise it.
Exactly.
Inflation.
Determines your
Right.
the
So
yield.
you got to remember, interest goes up, bond price goes down. Okay. Why does that happen? So let's say today, Chris, you have a bond price that's worth $100 and interest rate, and then you earn a yield of $4, 4%. Okay. And let's say that bond price is selling at $102, but the interest rate goes up, which means newer bonds going to be issued with a higher interest than your current bond that you have. So which means your current bond is going to be worth less.
Right.
Because people rather buy the newer bond with the higher interest rate than your current bond with the lower interest rate. And that's how interest affects bonds. Okay? All right. So if interest rates goes up, which means interest rates going up, these companies can offer you bonds with a higher interest rates, which means your bond price on your old ones, they dip. Nobody wants to buy those bonds because your interest rate on your old bonds are lower. And if it takes a long time before it mature, you have more risk towards it.
Frank, would you read that first bullet again that's blocked?
Interest rate risk. Okay. Credit risk. Default on these bonds. The issuer might default, right? They might not pay you back. Lower rating. Remember, we talked about if these creditors have lower rating, higher risk. This is probably when we talked about this. This is your junk bonds. Reinvestment risk. Well, if you're going to reinvest it with coupons, reinvest at a lower rate. So if the interest rate falls and your bond is mature and you're going to take that money, you're going to reinvest it, which means you buy a new bond. Guess what happens? You're buying a new bond at a lower rate.
Right.
So you have reinvestment risk. And all of this is control about how the feds control the economy. Okay. So when you understand how the feds control the economy, you can understand about bonds and other creditors out there very easily. That's why, to me, studying for your SIE, your security license, is fun. You should be smiling and really
Yes.
understanding the economy and market, how it goes and everything. Right?
That's what we do, financial education, right? If you
Yes.
understand how it works, then we make money work for us instead of us working for it.
Yes. And you understand, and then you can educate your clients more.
Mm-hmm.
Okay?
Yep.
And that builds trust. Trust builds clients.
Right. Long maturity, more interest rate risk. Lower rating, more credit risk, right? We know that. Okay. Question to you. If bond price increase, what happens to the bond yield?
Increase.
Decrease.
Decrease.
Should be decreased.
Decreases.
Bond yield is bond interest rate, bond coupon, right? Bond price goes up, interest rate goes
down.
Down.
Okay. Bond price move in opposite direction. I know we talk about that a lot, but they love to ask questions about this.
Mm-hmm.
Okay. All right, let's talk about mutual funds. A mutual fund pulls money from many investors to invest in a diverse portfolio managed by a professional. So let's say all of us on here, 189 of us on here, pull our money together to buy a pool of different stocks and bonds. Okay. For example, all right, does anybody tell me what is one price of NVIDIA is today?
300 and something dollars.
$300 something.
Yeah.
So let's say you only have $10 to invest. Can you buy NVIDIA stock?
Yes.
No,
You can buy a
No.
share, a
Can.
portion.
No.
it's a pool.
Right. But if we pull all our money together, we can be able to buy it, right?
Yes.
Yes.
So that's what basically it is. Pulling your money together. Okay. To buy these mutual funds, it can make up equities, bonds, money markets, and many different things in there.
So when you
Open
have
in,
fractional shares,
yes,
is that
you have a fraction
part
of
of the
share.
pool?
Yes, you have fraction
Okay.
of a share.
Okay.
Okay. So it's an open-end investment company. So basically, your mutual funds are open-ended. Okay. Investor purchase shares of a fund, professional manager, you invest in stock, bonds, and money market securities to provide diversification. You're diversing your money instead of in one stock, you many different stocks, many different bonds, money markets, and many different industries. Okay. And you can start with get in with a very low price.
Mm-hmm.
Many investors, one portfolio. All right. So let's talk about NAV and forward pricing. So this is important to understand with mutual fund. Mutual funds are priced at what we call NAV, net asset value, calculated once per day after the market close. Okay, so remember
Yes.
that once per day after the
After the
market close.
market close, NAV.
So how do you figure out what NAV is? Okay, what is NAV?
Net asset value.
Forward pricing.
You take the
Lia-
assets minus the
minus
liability
liability.
divided by the amount of
Number.
shares out there. Okay,
Repeat that.
so
Assets.
you take your assets minus your liabilities divided by the amount of shares. That's how they get the NAV. Okay, so they calculate the NAV at the end of the day. At the end of the close of the market, that's when they calculate the NAV. They calculate in that fund all the assets minus the liabilities divided by the number of shares. Okay. So let's say, for example, you go in there and you buy it today, you buy the stocks before the market close, you get the NAV at the end of the market close. Okay. If you buy it right now, after market, we're after market right now.
It's tomorrow.
When do they figure out what price you bought this mutual fund at?
End of tomorrow.
Next
End of
day.
tomorrow's
Next
fund.
day.
End of tomorrow.
Market
The end
next day.
of tomorrow. The next day's NAV, which is the end of the next day.
Frank, I have a
Yes.
question.
Yes.
Please, I missed something. You said assets minus liabilities divided by the
Yes.
Amount of
Number.
shares.
Total
amount
amount of
of
shares.
shares equals NAV or what?
Yeah.
NAV equals
Assets.
assets minus liabilities over the total amount of shares.
Thank you.
Okay.
Mm-hmm.
So you take the value of this is the value of the mutual fund, calculate once day based on the total assets minus the liabilities. There's an NAV, and then there is what they call a public offering price. Price the investors pay to buy the shares. Usually it comes with what they call a sales charge on that. Okay. So NAV plus the sales charge equals the public offering price. For example, let's say the NAV of that one mutual fund is $10. And they're going to charge you $1 for a sales charge. So the total public offering price is $11.
The sales charge.
If there is a sales charge, your public offering price is always going to be greater than the NAV. If there's no sales charge, your public offering price is the NAV.
That's where you get the term load and no load.
Correct. And we're going to talk about that in a second. Okay. All right. So I guess we were left off right here, right?
Yes.
So we talk about the NAV and the public offering price, right? But if you guys got your study material, the NAV is in the study material. It'll tell you how to calculate that. So your NAV plus your sales charge equals your public offering price. If there's sales charge, the public offering price is always going to be greater than NAV. No sales charge, it's equal. Okay, it's going to be equal. All right. Okay, so the types of fees and share classes, these are the mutual funds. You got Class A, which is front load. You charge the sale price on the front side. Pay up front. You have lower ongoing fees. Best for long-term investors. So if somebody wants to invest, and we call it buy and hold onto it, Class A is usually the best because they charge you up front, and your fees every year is a lower fee, right? So think about this. If you put in $10,000 today, and let's say the sales price, the sales charge is 5%. Would you rather have it on the 5% of the 10,000 that you put in, or later on they charge you on 100,000 later, right?
The front end.
Right. So Class B is back end. Pay when you sell. They don't charge you any over, and your fees decline over time. All right. There's fees decline over time. Contingent defer sales charge. They also be able to defer your sales charge over time too, and it's usually at the back end. Okay. Class C, no load. There's absolutely no load. So load means sales charge. Front load, back end load, no load is Class C, right? Or what they call level load. I'm sorry, Class C is level load, not no load. Higher ongoing 12B1 fees, we'll talk about that in a second, can become expensive over time because even though you have a level load, but the 12B1 is pretty high and it's going to be very expensive over time. No load, no sales charge, and may charge a 12B1 fees of less than 0.25%. Okay, so no low, no sales charge. Long term, you want share A's, Class A's. Short term, you want Class C's. No low, no fees. No low equals no fees. So think of just Class A, long term, short term, you want Class C. Okay. So what's the cost? Sometimes you have what we call break points, class A only. You get a discount on your front load depending how much money you buy. The more you buy, the more discount you get on your load. You reduce your sales charge, not your NAV. Your NAV is always going to be the same, no matter what. No matter what class you buy, your NAV is going to be the same. It's just you're reducing your sales charge. So just like if you go to Costco or your Sam's, you buy more, you get what? You get less. When you get less on far as sales charge.
Mhm.
So if you, let's say, for example, you buy, you invest in $10,000, they might charge you 5%. You invest 100,000, they might charge you 3.5%.
Been selected as the
Okay.
leader of the crew.
Okay. Now, I want to tell you on this part, there's one prohibit activity is to do is that if you know the cutoff point for a sales charge reduced, let's say, for example, is 100,000. And you're going to go to somebody and say, hey, just put in $99,000.
Hmm.
You just did something that's prohibited. Because you just basically tell them to stay below the next level so that you can get a higher sales charge. Higher sales charge would mean what, guys?
More commissions for you.
Higher commission for you. Okay. You always got to do what's right for the client. Now, you also have letter intent. You could say, I can have a letter intent to buy more. Based on that letter intent, that would charge you less. Or you can do what they say, you can combine all your assets together from your family. All right. So, Chris, let's say you and your wife buys mutual funds from the same company, same class, then same family, then they can reduce it. Or you have other family members, they can reduce it too. Okay. So that's breakpoints for class A. 12B1 fees are not sales charge fees. They're usually just used for marketing and distribution fees, distributing paperwork and things like that, including an expense ratio. So no load, they charge you less than 0.25%. If there's a low, it's usually greater than 0.25%. Because you think about it, if you're keeping something short term, you want something that's got no load, right? Low 12B1 fees, because there's less work for them to do. Long term, they're going to charge you a higher 12B1 fees. All right. So example here. Let's say, for example, you have an investment, $10,000 investment at a 5% low. That's $500 fee, right?
Mhm.
So your actual investment is $9,500. Okay. Okay. ETFs, we have something we call exchange traded funds versus mutual funds. ETF are traded on exchange. Mutual funds are not traded on exchange.
Yes.
Mutual funds are open-ended, which means that they basically you don't exchange mutual funds, you exchange ETFs. Intraday trading, which means basically you can trade within the day and whatever price it is, that moment that you trade is the price for the ETF. Mutual funds, the price is at the end of the day. The NAV at the end of the day. ETFs, the expense ratio is usually lower compared to mutual funds.
So anytime they're talking about an NAV, you're talking mutual funds.
Correct. A lot of people like to do ETFs because it's lower fees, and they can sell it throughout the whole day, and it's exchange. Mutual funds is just, every time you buy a mutual fund, you're actually buying a new mutual fund, open-ended, okay? Which means there's always adding more shares onto it.
Is this where day traders come in and they'll buy stuff throughout the day, and they'll see something lower in the morning, and then by the afternoon it goes up, then they trade it and they sell it?
It could be that, or Chris, they're trading stocks.
Mm-hmm.
Yeah. Okay. All right. Let's talk about variable products. All right. Definition: investment based on insurance products. So variable products. We got variable annuity, variable life insurance. Okay. So investment based on insurance products. So annuity is an insurance product. Life insurance, of course, is an insurance product. Investment based on insurance product. Value fluctuate with the market. No guarantee returns. Customer bears the investment risk. Okay. So if you know life insurance, you guys know annuities, you should know this. Risk, market volatility. All right. You also have risk, higher fees. And because it's an insurance product, you have surrender fees if you break the contract. Okay. Those are your risks. Market going up and down, you risk because you have higher fees, and then you have surrender charge on variable annuities, variable life insurance. Benefit is that it continued to grow tax deferred, right? Even if it's non-qualified money, it still grow tax deferred. Regulations, it's sold by with a prospectus, regulated by FINRA and the SEC, just like your market, just like your mutual funds, just like your stocks. You got variable annuities, it's income and retirement, variable life, death benefit, and investments. Okay, that should be pretty straightforward for everybody. Now, you also have what we call REITs and limited partnerships. REITs are real estate investment trusts. REITs is basically investment, you're investing in real estate plus income. Invest in real estate, provide incomes, so you get dividends, subject to market and interest rate risk. So when you do on REITs, right, and you have this investment trust, so if the market goes up, of course your REIT's going to go up, right? But how's the interest rate affects your REITs?
The kind of properties that people can buy, because the higher the interest rate, the higher the
Correct. So, Chris, you were right on point. Was that, remember, the Feds control the interest rate. So if the interest rate goes up, you know what? Your house those REITs, they might not be able to sell as much, or it might be worth less. And if you're investing into REITs, you have liquidity risks, right?
Mm-hmm.
Homes are not liquid.
Right.
Real estates are not liquid. It could be land, could be building, could be homes. You also have what we call limited partnerships. This is very passive and it's not liquid, illiquid. Passive investment. You invest into a partnership. All right. You're limited partners. Limited liability because you're limited partner, you have limited liability. But it's very what? Illiquid. And it is a tax advantage. It's going to be passed through. Both have a market and liquid risk. Again, market risk based on whatever partnerships you're investing into. And it's not liquid.
What is pass-through?
Pass-through is just basically a tax thing where it's a tax advantage for you. Okay? But, Fernando, we don't teach tax classes here, right? So, what's good for this situation? It depends on the person, right? If they like it and they don't need the liquidity and they will take the risks of the market, and it might be good for them. All right.
Frank, when it says illiquid, that means it's not liquid.
Yes.
Okay.
That's a fancy, Cynthia, that's just a fancy word, mean not liquid. You know, some of these lawyers, when they do these tests, they just love to put in fancy words that means the same thing. Coupon yields and interest rate. Why can't they just stick to one word? I hope we don't have any lawyers on here. All right. Let's talk about ETFs and ETNs. All right. So ETFs, we talked about that, right? Trade like stocks intraday throughout the day, market price, hold underlying assets, generally have lower expense, right? Exchange traded notes, and notes are debts. Notes, pretty much loans, it's a note, right? You have a loan, you have a note. You have a debt, you have a note, right? Sometimes they call your car loan, right? Or your car note, right? Same thing. Unsecured debt of an issuer. So it's unsecured. No ownership of assets. Return linked based on a link to an index, just like your ETF. Subject to credit risk, right? Again, if you have a note and the creditor is not good, it's not going to be good for you. All right, let's talk about everybody's favorite subject when you start taking this test. We're going to talk about options, puts and calls, right? Everybody loves puts and calls. Okay. This is actually one of the hardest things to understand on here, but it also will take a lot of time when you're taking the test and you get all confused and you get all rattled. Okay. But guys, I'm trying to explain it as simple as possible that you can be able to understand it. Options, all right? So you'll be able to buy options. An option is a contract. Option is a contract. That's all it is. Between a buyer and a seller, and gives the buyer the right and the seller the obligation to buy or sell. So I have an option, which means I have a contract, and I'm a buyer. I'm a buyer. I have the right. A buyer has the right to either buy or sell. And if I am a seller, I have the obligation to buy or sell. Okay. A buyer calls. Okay. Okay. So a buyer and seller is the person is doing the transaction. It's also called long and short. A buyer is long, a seller is short. They're going to get you that word too. Buyer is long, seller is short. When a buyer calls, I want you to remember this. When I call you, I have the right to buy. When I call you, I think the market's going to go up. Okay? Which means I think the market's going to be bullish. Call means bullish. So if I'm a buyer or I am long, same thing as a buyer, and if I call, I think the market's going to go up. And I have the right to buy. If I'm a buyer or I am long and if I put, which means I put down, just remember, put down, I have the right to sell. Just remember, I want to buy when it goes up. I want to sell when it goes down.
Frank, can you repeat that, the pool part again, please?
The put part,
Yeah.
I'm a buyer. A buyer is also called a long. Okay. If I'm a buyer, if I call, I have the right to buy. When I call, I think it's going to go up. I think it's going to be bullish. When I put, all right, Chrissy, when I put, which means I put down, I think the market's going to go down. And I want the right to sell. Okay. I'm a seller. Okay. Seller means short. All right. I'm a seller. I have the obligation when the market goes up, I have the obligation to sell. When the market goes down, which
I
is
have
a
a
put,
question.
hold on a second. When the market's put, I have the obligation to buy. Okay. So what was your question?
Both buyer and seller buy the options.
No. One has the right to buy or sell. The other one has the obligation. What's a right? Right, which means I can buy or not buy, or I can sell or not sell. But when I'm a seller, right, I am obligated to sell or buy.
Okay, Frank, would you say that the puts is normally when the price is down?
Yes, puts
Would
means
one
the
say
market
that?
goes down. Just remember, I put down.
Okay.
The market's going down. I call up. Okay. I put down, I call up. So let me share something with you guys.
This is where people can lose or make a lot of money in the market because it's highly speculative, right?
Right. So this is one of the things when you get into the test, you want to write things down. Remember, we write down what? Interest rate goes up, bond goes down, right? This is the other thing you want to write down. I'm a long, I'm a buyer. I'm a short, I'm a seller. Long equals buyer, short equals seller. When I'm a long buyer, I'm a long or I'm a buyer, and I make a call, I think the market's going to go up. If I'm a buyer, which I'm a long, I put, I put down, I think the market's going to go down. I'm a seller or I'm short. Okay. Let's say Chris, all right? Chris, let's say I'm a broker dealer, whatever. Chris calls me, he's the buyer, and he's going to say, Frank, I'm going to buy because I want to call. I have the right to buy. I think the market's going to go up. I think this stock price is going to go down. And me, I'm going to short him. I'm going to say, okay, Chris, I'm going to do that, but I'm going to charge you a premium on this, Chris, for this transaction. Okay. If the market does not go up, it actually goes down. Chris has the right to buy, but he won't buy because the market didn't behave the way it did. He wanted to. So then he just lose the premium. And I make the premium. Okay. But if the market does behave like Chris wanted to, then he's going to have the right to buy. He's going to buy it. Then I have the obligation to sell it to him. Okay. Crystal clear for everybody, right?
No.
No.
Is
Of course
this,
not.
how does margins play into this?
Margin has nothing to do with this.
Okay.
Okay. Margin has nothing to do with this. All right. Let me to explain it to you. I created a couple more slides because I knew you guys were going to have questions. Options, right? Okay. Options, your rights. Remember, when you have an options, right? You're long. This is when you're long. You have option. You have right, not an obligation. You have your options. When you are a long option, which means you're a buyer, you have an obligation. You don't have an obligation. You have the right. Okay. You write the right to call, or you have the right to put. Remember that. You have the right to call, or you write the right to put.
To put.
Okay. One contract equals 100 shares. One contract equals 100 shares. The buyer always paid a premium. The buyer is also known as long. Okay. I told you they love to use many different words. The buyer is also known as long. The buyer has the right to buy or sell a contract. One contract equals 100 shares. And that comes with a premium. They have to pay a premium.
Mm-hmm.
Okay. And like Chris says, this is for hedging and speculation. You're speculating what the market will do.
Next.
Okay. You got that?
Yeah.
Okay. This is an example. You have the right to buy at a strike price, and you are a long buyer. You're a buyer, you're long, right? And so when you make a call, you call options. Call means call up. You think the market's going to go up. You think it's going to be bullish. So you expect the price to go up. For example, you buy one call, which is 100 share, right? And the strike price is 50. So the strike price, which means the price at the time you agree on, the stock price is $50. And the premium is $3 per a share. And the stock price goes up to 60. If I am a buyer, I made that call. If the price goes up to 60, I have the rights to buy that stock at $50. Okay.
So you made
So the
you make a
profit is,
profit.
the current price is 60. The strike price was 50,
Mm-hmm.
right? Minus $3 premium times 100 shares. I just made $700.
Right, right.
The maximum that you can lose,
It's
because if
$300.
I am a buyer and I make a call and the market its strike price is at 50, and let's say the stock price becomes 53 or it stays at 51, 52, or 50, right? Or comes 49, 47, then maximum I lose is just a premium of $3 per share. I got that?
Yeah.
To make it a little simpler to understand that? Yes, no?
Yes, I understand.
Okay, now
Yes.
let's say I am a buyer, which I'm also long, right? Buyer means long, and I'm going to do a put option. Put means what? It's you think the market's going to be put down, going down. It's going to be
Short.
bearish. You have the right to sell.
Mhm.
So example, you buy one contract, the strike price is at 50, the premium, let's say for example, is $4. The stock prop falls to $40. So 50 minus 40 minus $4 times 100, you made $600. Okay? Your maximum loss is always going to be if you're a buyer, it doesn't matter if you're called or short, your maximum loss will always be the premium price. Everybody got that?
Yeah.
Okay.
So just in case if the stocks does not fall to $40, they are at 45. Are they still able to sell at that point?
You have the right to sell. You could, but
Okay.
then you might not make anything.
Okay.
So let's say it's at 45,
Mm-hmm.
right? So 50 minus 45 minus the $4
Mm-hmm.
Only $1.
on
You
$1
make
that
$100.
you still lost, but your maximum loss is 400
Okay.
because you have the right to sell. You don't have to, but you do have the right. Now, if you're on the other side,
Mm-hmm.
you're not a long, but you're a short.
Mm-hmm.
You are a seller. If this is the case right here, you have the obligation to buy. So which means you have the obligation to buy, which means you buy the difference between $50 and $40. Okay. So which means you're going to lose $600.
Wow.
If somebody's gaining $600, somebody's losing $600.
$100.
Okay. You want to be a what they call a short. You want to be a short, which means you are a what? You have the obligation. You want to be a short because you don't think the market's going to go up or down. You're going to think the market's going to stay the same or the opposite of what the other person thinks. And all you do is making money from the premium.
Mm.
Okay. All right. So let's say, for example, questions. Let's see if y'all can answer this. The buyer buys, which is long call. Strike price 40, premiums 2, strike price stock price goes to 50. How much is the profit?
800.
All right, just keep the answer yourself. Let everybody get a chance to answer it.
Okay.
You buy long put. Strike price 60, premiums 5, stock price is at 50. Did you profit and how much? And what's the maximum loss for a call buyer?
Gotta find that, work that out.
Sure. When you read these questions out, guys, they're just kind of confusing. You got to know what a call is, what a buyer is, what a long is, what a short is, what a call and a put is. And if you get confused, when you sit down, you write it yourself. A buyer equals long. A short equals what? A seller. Okay? All right, so first answer is 800.
Let me see.
Everybody got that?
Yes.
Second answer
500.
500.
Third answer 200.
Whatever the premium is.
Whatever the premium, 60 minus 50 minus $5 premium times 100. One contract is always 100 shares. And the maximum loss is
Whatever
the
the premium
premium
is.
paid.
Premium pay.
Okay? Nobody should have any questions about that anymore, right? You know it, right? So a buyer is a long, a seller is a short. Okay? Buyer is a
And
long, and a seller is a short.
the strike price is what the stock starts at. That's where
Correct.
it begins at. So just
Right.
remember the strike price is what it originally starts at. If it goes up, you've got a call, goes up, you put a put, it goes down. Either add or subtract from the strike price.
Yep. That's what you want. Okay? That's what you think is going to happen. But the majority of the times, guys, it's not going to happen when
Doesn't
you have
happen
it.
that
You
way.
just lose the premium. That's why it's out there. If it always goes with what you think it is, people will make, everybody would be doing puts and calls all day long. Okay? All right. So types of risks. Oh, we got 18 minutes left. Types of risks. Market risk, overall market movement, whatever the market does. Interest rate risk, bond price reverse to interest rate, right? We know that. Credit risk, issuer may default. Inflation risk, purchasing power. Liquidity risk, difficulty in selling. There's another risk that's not on here. It's called systemic risk.
Systemic?
Systemic risk. It affects the whole system, everything. It can affect the market. It can affect interest rate. It can affect creditors, inflation, liquidity, everything. For example, the war that was going on in Iran, all right? That's a systemic because it can affect everything. One stock going down is a market risk. What you invest in, it could be inflation risk, it could be liquidity, it could be credit risk, it could be interest rate risk or market risk, but not a systemic unless it affects everybody. All right, so match each product with the primary risk. Stocks. What's the risk on stocks?
Market risk.
Market risk.
Market.
If you invest in stocks, the market goes up and down, that's what you risk. What about bonds?
Interest rate.
Interest rates.
Interest rate.
Interest rate. Bonds is always interest rate, right? Junk bonds.
Credit risk.
Credit risk.
Credit risk. Illiquid.
Liquidity risk.
Liquidity.
Liquidity risk. That's in the name right there. Mr. Jardita, you have your hand raised? You're muted. You're muted.
It's raining cat and dogs here in Florida.
Sorry about that. So I'm trying to.
Here in Dallas, though, also.
Okay. Did you have a question, ma'am?
Yes, I was trying to log into using my phone because my computer battery is dying, but it's not allowing me. Should I just leave this? Should I leave my computer then join on my phone?
You gotta, yeah, you can't be on two Zoom at the same time when you do this.
Oh, okay.
Okay?
All right. Thanks, Frank.
No problem, no problem.
It's storming here in Florida. Thunderstorm, rain.
Well, I guess we just moved from Texas to Florida that fast.
Not in Austin.
All right. Trading accounts and prohibited activities, okay? Order types, market, execute immediately. If you say I want to order based on the market, when it execute immediately. Okay. Limit, control price, not guarantee. I want to limit. If I put a limit, then let's say I want to buy up to a limit, or I want to sell to a limit. Stop, triggers market order, or I put a stop. Hey, I want you to, if it gets to this price, I want you to sell. It gets to this price, I want you to buy. That's a
Is
stop.
that stop loss?
Well, that's a stop. All right.
Okay,
Stop order.
stop order.
There's accounts. There's a cash account, pays in full, no borrowing. Margin account, you can be able to borrow.
Can
But
you
it has a higher
explain more about its order type, more detail? Market limit stop, please.
market limit. So market is when you place an order, whatever the price is, that current price, that's the price that you buy it at or you sell it at. Limit, you control the price, not guarantee execution. You says, you know what? I'm limited to, if it gets to this price, stop buying or stop selling. Stop triggers market order. Stop means basically, if it gets to this price, stop. I want you to sell. Or it gets to this price, I want you to buy.
Can you give examples?
Krista, I just gave you an example.
Yeah.
What is the difference between limit and stop?
Control the price, not guarantee. Basically, stop is you trigger market order. Stop with the word stop actually doesn't mean stop. It actually, okay, at that price, I want you to trigger market order. At this price, I want you to sell. At this price, I want you to buy.
Also, that means you can set your limit, the price of what
Right.
you want, right?
Right.
And then you
Correct.
can say, okay, from 5 to 10. So
Correct.
if the market is 10, is you can sell. If market
You
low
whatever, yes,
than 10,
right.
then
Whatever you tell them, the stop order.
Oh, okay, got it. Understand. Thank you so much, Frank.
No problem. And then on the accounts, you got the cash and the margins. Margins you can borrow. Prohibited activities. Insider trading, guys. If you know of something, that information that's not public, you cannot use that information to buy or sell. Market manipulation. You cannot manipulate the market.
Get in
Some
trouble.
people will go in there and manipulate the market and make the stock looks better than it is. All right. And then it makes the price goes up.
Mm-hmm.
You keep selling, or buying. You're manipulating the market, you make it go up. Or churning. Churning is a big one that a lot of agents got to know about. Churning is you keep on selling them something. Let's say you keep on buying and selling and buying and selling so that you can create more commission for yourself.
Okay.
Yes,
Hey.
Miss Mary Lee or
Mary.
Alex.
Yeah, it's Mary. Frank, about the insider trading. I think, yeah, if you're sitting in a cafe and you overheard it, can you still
Nope,
trade?
that's not public information.
No.
When you are licensed, Miss Mary, and you hear it, it's not public information. Public has got to be printed. It's got to be out there. Not because you eavesdrop in a coffee shop. An executive or somebody, okay? Or you accidentally eavesdrop.
Yeah. Right.
Okay. You go to a party and you know Martha Stewart, and Martha Stewart told you something and you acted on that and you know it, especially if you know it's insider trading. Okay. Market manipulation and churning. Churning is a big one for us because there are people who keep on creating accounts for somebody. You open up them a variable annuity. A couple years later, you convert that to another account, and you convert that to another account. You keep on upgrading your life insurance. All right. You keep on upgrading them. You're churning. You put him into one investment, Cynthia, and then 6 months later, you put him into another investment with the same money.
Hmm.
And you keep on churning. That's not the best thing for your client. If it's the best thing for your client, then okay, it's not illegal. But you're
Frank,
doing it just to make profit, it's illegal. Yes, ma'am.
Frank, yeah, if let's say the clients build up some, like I'll say like a cash value type, if they're able to get some growth and they use that money to open another account, will that be prohibited?
If it's the right thing to do for the client, it's okay. But if you did it just for the sole purpose of you creating commission for yourself,
Commission for yourself.
Go to jail.
you cannot say, "Oh my gosh, I need my 315. It's at the end of the month. Let me convert this policy over." Okay. Market equals execution, limit, price, margin is risk. Margin is always risk because when you borrow money.
Mm-hmm.
Okay. Settlement date. When payments is made and security is delivered. All right. So you have a trade date, the date that you trade, and then it's settled. Trade date +1. Okay. So trade today, settle tomorrow. Just skip weekends and holiday. And when it's settled, that's when the payment is made and securities are delivered. It's easier now because of electronic, but imagine back in the day, they had to deliver you your security by mail or by hand. Dividends timeline. All right. So when the company declares a dividend will be paid, that's the declaration date. That's the day they declare, hey, we're going to pay this dividend. How much? Ex-dividend date. Buyers of the stock on this date or after will not receive dividends. Okay. Companies records names of shareholders who will receive the dividends the date of record, and the pay date is when they pay out your dividends. So they declare that you're going to get dividends. The ex-dividend date, buyers of the stocks of this date or afterwards will not receive dividends. Okay. Date of record, pay date. This is just the ex-dividend date is probably the most important date to remember because that's the date when you buy, you won't get dividends. Okay, so questions. An investor purchased security in a margin account. So what's a margin account?
Borrow money.
Borrow. Borrow. So that's another word. Just same thing, another word, borrow. Which of the following statement is true regarding a margin account?
C.
Letter A. A. Letter A.
It's A. The investor may borrow funds from the broker-dealer to increase the purchasing power. And so let's say I only have 50,000 in my account with this broker-dealer, but I want to buy $100,000 worth of stocks or mutual fund. I borrow the other 50, right? To increase my purchasing power. Margins account reduced investor overall risk. The overall risk is still the same, right? It doesn't matter if you borrow or not. Security purchase on margin must be paid in full at settlement.
Yes.
No, it's not being paid. You borrow money, right?
Well, yes.
Loss in margin account are limited to initial investment. No. When you borrow, it's limited to what? It's not only to your investment, but what you borrow too. because you can actually lose everything. If the market goes down and you lose everything, not only you lose what's in there, you lose what you borrow too. Margins use leverage. Increased risk can lead to losses greater than the initial investment.
Wow.
Okay. So yes, that can happen. Raul, you had your hand up? All right. Okay. Don't sigh, smile. It's happy, okay? Taking a test. It's happy. All right. Prohibit, I remember we talked about this. Insider trading, using material non-public, Miss Mary, non-public, illegal to trade or tip. You cannot tip one of your clients, say, hey, I heard this is gonna happen. I heard about this. You should buy this.
The president does it.
That's why he's the president.
No, let's not talk politics on here, guys. Stick to the test.
All the congressmen do it.
The tipper and the tippee both are liable.
Yep.
Let's stick to the test, guys. No politics, okay, guys? I don't want to get canceled
in
by
trouble.
anybody. Market manipulation, artificial influence in the price creates false market activity, always illegal. Okay. Churning, excessive trading done to generate commission, not in client's best interest, not aligned with objective. If it's unfair, misleading, or for personal gain, it's prohibited.
It's prohibited.
And you guys know what is prohibited, not prohibited. Common sense. Okay.
Yes.
All right. U.S. regulatories, markets. The market's controlled by the SEC. They oversee exchange. Remember, this part right here we're going to talk about is only 7% of the test, okay? Oversees federal security laws. The munis is municipal security. They oversees the muni bonds, municipal bonds. Firms like the FINRA. FINRA regulates broker-dealers and reps like you and I. They also regulate the OTC. The feds, what do they do? They regulate money, right? Set margins, like a brokerage borrow margin. Borrow margins not only for brokerage account, how much you can borrow, what percentage, but also set margins for what? Controls the margins for the banks and control interest rate, money supply, and all of that. Okay. So Security Exchange Commission controls the overall market and exchange. Top regulatory enforce securities. Okay. So Rule 144, when restricted and controlled stocks can be resold. Sometimes you have a stock, it gets restricted. They locked it. Restricted time restriction. You can't sell it, you can't buy it, or they control the volume, how much it can be sold or buy. Waiting period. Sometimes they have a waiting period, 6 months waiting period, reporting company, 1 year, non-reporting. So they make for you to wait too, before you can sell or buy. Or they set conditions on selling or buying. This never happens. They do this, certain companies, when they try to control the economy, okay, guys? Sometimes if they think the market's going to drop too fast, they might put a waiting period on things. Okay.
Will that also affect the lock period, the restricted and controlled stock?
It could. They might not lock it, but they might just say there's a waiting period. Or they might put conditions onto it, but not lock it. You need to file and stuff like that. Okay.
So what would be the example of when it's locked? I'm sorry. So
lock, which means you can't buy it at all or sell it at all.
Why?
Or, well, there's certain things they want to control with the market, or they want to control the company. All right. They think that the company the stock price is getting out of control, or the economy. Okay. Remember, their job, the SEC job, right, is to oversee the market and exchange. So if you want your company to exchange in the market, you got to abide by their rules. So SIPC versus FDIC. Yeah, I know what the FDIC is, right? It covers banks deposits. Up to 250,000 per depositor per bank.
Per account.
All right, per depositor per bank, covers checking, savings, CDs, does not cover investments. So if you got investment in the bank, it does not cover it. On the other side, Security Investment Protection Corporation, SIPC, covers brokerage account up to $500,000 per customer. 250,000 maximum for cash. So you can have a brokerage account and you can have cash sitting in your brokerage account. That broker, you haven't told that broker what to do with that cash yet. It's just sitting there. You haven't bought anything, it's just sitting there. So you're protected to $250,000 worth of cash. Protection of a broker dealer fails does not protect against market loss. So if the market goes down, it does not protect against that. So SIPC, brokerage protection, FDIC, bank protection.
Mr. Frank?
Yes,
Yeah, so question in regards to the SIPC, is it new? Were they there when Enron happened?
it's always been there.
Oh, okay.
Okay.
Explains a lot. Okay.
Remember, it's not Enron was a company, not a broker dealer.
Mm. Ah, okay. Okay,
But
never mind.
Enron was a case where you can remember we talked about the stop and the lock and stuff like that. They can also do that.
Mr. Frank,
Yes.
so if I have 250K and it makes profit, what do they do with the profit?
They keep it.
Who keeps it?
The bank.
But
If life is still.
only if the bank goes down.
Mm-hmm.
Only if the bank fails, and then you are secure up to 250,000. If you have more, and that bank goes bankrupt.
That's too bad.
Oh,
Yes.
oh,
So
no.
you know how to solve that problem? Just don't have that much money. Just
Okay.
be poor.
They spread your money all over the banks.
Correct? Or you put it into a bank that is very credible bank.
One that's too big to fail, right?
Correct.
Fail like Aegon.
That's not a bank.
Yes, Aegon's not a bank. All right. Financial protection. All right. SPIC protects the brokerage protection. Protects the cover if a brokerage dealer fails, not market loss. FDIC protects deposit if a bank fails. Conduct protection, behavior. So on the behavior side, you're protected by suitability and best interest. Recommendation must be suitable and in the client's best interest. And you have to have disclosure. You got to disclose the risks. You got to disclose the fees. You got to disclose any conflict interest. And one of the biggest conflict interest is you receiving commission. When you do a security products, you always have to disclose that you get commissions. You make money. That is the biggest conflict. Protect your asset, protect your decision. The feds, the SPIC and the FDIC protects your assets from brokerage fail and all these protection from, all right, from FINRA protects your conduct. Okay?
Frank, question, is that
Yes.
as a broker or as an individual like us?
Both. The conduct behavior is both.
Okay, and the SIPC?
That's at the broker dealer.
Okay, thank you.
but we have E&O to protect us. Anti-money laundering prevents illegal money from entering the financial system. All firms must have anti-money officers. You guys should know this, being life and health licensed, who monitor and report suspicious activities. So let's take a look at that. Cash deposit of 100,000 plus, you must file a CTR, currency transaction report. Frequent wires. If you're suspected of somebody is frequently wiring stuff, you file a suspicious report. Excessive journals, you investigate and file a suspicious report. Structuring, illegal, avoiding the CTR. If you're trying to structure, you know it's 10,000. You go in there, you know what? I'm going to do it at 9,999. I am trying to structure things.
I'm all right. What's up?
Uh-oh.
Okay? So that's what it means. A new customer opens an account, deposits $12,000 in cash, initiates multiple wire transfer to unrelated parties. Which action must the firm take?
CTR.
Letter D.
D.
Letter D.
Letter D.
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 Verify the entity, screen, file a CTR and a suspicious report. If you do multiple wires to unrelated parties, all right, they're filing a suspicious report. And you will never know they're filing a suspicious report and a CTR on you. Okay? All right, guys. So last thing we're going to talk about is test taking tips. Do a practice exam over and over and over until you get a 80 plus. This is the most important thing. You can go through this class, which will help you. You can go through this material, which will help you. But you got to do the practice exam over and over and over. You know, you go to the website. All right. When you schedule your SIE, there's actually some exams on there. Some exam questions on there. And your study material has it. Your best friend chat has it. All right. Chat and AI has it. Watch for those questions. Except all is true and false, double negatives. And I always say the answer is in the question. Read the questions. The answer is there. Okay? Read the questions and the answer is there. And remember, sometimes they will cross you up with just different words, but it means the same thing. Okay? So I want to wish everybody good luck. We will have this class every Tuesday until G26. And you cannot pass if you don't take the test. Okay? So don't be afraid to take the test. Just take the test so that you can be able to pass. Don't study too long. Study for a couple of weeks, every day, couple of weeks, and just pass. Believe in yourself. It's simple. It's easy. You can be able to do it.
Just quick question. Anybody know how much the test is?
$100.
Frank, do you have to
Thank you,
register
Frank.
for all the classes, or one registration covers everything?
Thank you, Frank. Thank you.
Thank you, Frank.
Thank you so
This
much.
class, you have to
Frank.
register for.
Thank you, Frank.
Thank you,
Thank
Frank.
you.
Frank, thank you.
No problem.
So next week I have to
Thank you.
register again.
Thank you,
Thank you,
Frank.
Frank.
you, Frank.
Thank you,
Okay.
Frank.
Thank you.
All right, no
Thank
problem.
you.
We'll see y'all later.
Bye, everyone.
Thank you,
Thank you so
Frank.
much.
Nice.
That was
Great. Great
I had a
training.
great time. I learned
Now
a
you can
lot.
take a picture.
I'm in class. I'm in class.